Welcome to FT Markets. Sorry, not today, come back another time. That was the message from Janet Yellen and her Federal Reserve colleagues as the US Central Bank decided to keep rates on hold at their September meeting as worries about the global economy persist. So, what was the reaction in Europe? Well, the euro was up, bond prices also went up, equities have gone down. So what are the short-term and medium-term implications of the Fed's decision? With me to discuss this is the FT Markets editor, Mike Mackenzie. Mike, let's start with the euro, which is seeing a slowdown in, which is moving towards 115, which has been pretty weak as far as the dollar's concerned. Stronger euro, weaker dollar. That's been the story for the last few weeks, and looks like it's going to be continuing along that path.
Yes, as you can see from here, we've had a nice jump, basically one figure change from below 114 to over 115 in the last 24 hours. And that's essentially a disappointment trade. The Fed, by sort of not raising rates, has kind of tempered the dollar bulls, and as a result, the euro's picked up some steam. The implication of this, of course, is quite profound for equity investors in Europe.
Yeah. So, I mean, in terms of the trend that's going to be, I mean, do you remember the days when we were talking about euro-dollar parity?
Yeah.
I mean, that's now to the point whereby we have two central banks both wanting pretty weak currencies.
Well, I'm not sure the Fed wants a weak currency. They've seen a tightening of financial conditions in the US economy because the dollar has been picking up steam. And because the dollar's been strengthening, it's hit commodity prices hard, and it's put a lot of pressure on emerging markets. And if you look across emerging market economies, they have a lot of dollar-denominated debt. So the last thing you want when your currency is weakening is the dollar goes up, and you're now having to pay back that debt in depreciating local currency terms. So the Fed, I think, has essentially said, we're worried about China, we're worried about the global economy, we're holding fire, and they want to see the dollar sort of calm down a little bit. But yes, you're right. You talk about the eurozone. This is an economy that's still pretty much on life support. You've got a central bank in Europe that's doing enormous amounts of bond buying. They want and they need a weaker currency. And it's, funnily enough, when we were talking about, or the market was talking about, potentially the dollar and euro reaching parity earlier this year, that coincided with the peak in European stock prices. And we're way away from the peak now.
Let's look at the next chart, which probably tells us that Mario Draghi, president of the European Central Bank, is going to have to extend quantitative easing.
He's going to have to do something because he wants to weaken his currency and he wants to fire up the stock market so you have a greater wealth effect. And this is not a pretty picture if you're an ECB official.
And this has been, this was once a great equity bull run, but it's been coming off for quite a while. What's the likely direction, depending on how the dollar goes against the euro?
Well, if you get a stronger dollar and a weaker euro, the exporters in Europe get higher foreign revenues. And if you think back to the US bull run in 2011, 2012, when QE was being done by the Fed, and the Fed was weakening, and that was actually saw the dollar weaken quite a lot. The bulls in New York loved it because every time companies produced their earnings, they were getting a great fillip from the fact that they were getting stronger foreign revenues. So you want to, this is what European investors, and this is sort of the investment bull case in part for why you want to own European stocks. So that's why the currency is so important.
Okay, and the bond market, let's see how that's been playing. That's the European bonds have pretty much been tracking what US Treasuries have been doing, is that right?
Yes, well, Treasury's got a nice boost yesterday. They were beginning of, I mean, the Treasury market has long felt that the Fed's projections for interest rates and the economy in general have been far too rosy. And yet again, yesterday, the bond market prevailed. Their view prevailed. The Fed didn't raise rates. And as a result, you've had a nice rally last night in US Treasury market, and that's now spilled over here into the eurozone and also for the UK. And interesting thing about the UK is that they, along with the Fed, are seen as really the only two major central banks in a position to actually raise rates in the next few months. So we've seen a pronounced drop in yields and a rise in prices for UK gilts, and the same here for France and Germany. That's a little bit more of a concern in the eurozone, given that that would suggest that the global environment is not too good here, and instead of owning stocks in the eurozone, you'd rather be, but you're more comfortable owning bonds, which essentially, as you can see in Germany and France, don't really give you much of a coupon.
Well, the global environment's not great anywhere, and our final chart is about the Fed's thinking on whether rates are going to happen this year. I mean, the prospects are receding in general, aren't they?
Yes, they are. I mean, the bond market now prices in less than a 50% chance that the rates go up this year.
Mike, but this is how the Federal Reserve members think rates will what their expectations of rate movements are going to be.
Yes,
and here we see the first arrival of a negative rate for some time.
Yes, although again the Fed is a committee, and whilst you had one official yesterday saying he thinks rates should be negative, you had another official, Jeffrey Lacker, who dissented and said the Fed should have raised rates. So you can see the polarization of opinions there on the Fed.
But the general trend is.
But the general trend is that these dots have been coming down. You're looking at by the end of 2016, they're expecting it to be a lot lower than where they were saying a year ago. So in general, the Fed is slowly coming around to the bond market's view of the world, which is that rates are going to be very low. Even if they do finally raise rates, the increases in borrowing costs are going to be very small.
Even if they do finally raise rates. I mean, is there get to a point in this cycle whereby it just becomes too late to raise rates?
There is a risk there, and I mean, the bear case for the US economy is very much one of where, okay, you're looking at S&P 500 earnings, they're weakening. They actually were negative last quarter on a year-over-year basis. Revenue growth is anemic for major US companies, and in part that reflects the stronger dollar, which has hit their foreign earnings or foreign revenues. You also got a situation now where banks in the US are going to start calling in their loans for the oil and gas industry. And shale gas and oil exploration in the US has been a huge driver of economic activity in the last few years. But now with oil prices having fallen so much, which is part of the commodity story, you could make a case that you're not going to see as much CapEx in the US economy, and that filters through. So things aren't looking so good. And also what was lost, I think, in the Fed's, all the focus on the Fed yesterday, the US Bureau of Labor Statistics came out with a revision. And for the 12 months to March of this year, they knocked just over 200,000 jobs off payrolls. So
we thought payrolls was going
yes,
gangbusters.
So, and again, if you look at the labour participation rate, unemployment rate is low, but the labour participation rate is also very low. It's come off dramatically. So you're not seeing any wage pressure. I mean, the key here now, and the Fed has basically told us they're worried about China, and if you're a bullish investor on US equities, generally, the one question you're asking yourself is, what does the Fed know that I don't?
Yes. Mike, thanks very much indeed. So there we have it. The Fed has kicked the can down the road, but the question is whether the road is going to start running out.